Morning, everyone. Welcome to this week's webinar. My name is Sam, and I'm an economist in VSR. Okay, to start with, in our agenda today, we got an outlook on Eurozone, and then my colleagues will guide you through their specific stock updates and initiation of one of the counter. So to start with on Eurozone, I would like to emphasize that we still maintain a neutral weight on the economy and in their equity market as well. And I'll guide you through the reasons behind that. To start with, the Eurozone economy is poised to show some positive growth this year. We actually saw some started during, for the last few quarters already. The recovery in future, we believe, will be shifted towards domestic consumptions rather than on exports, and that will help the region itself more. And how is that all possible now? All of a sudden, it's because of the loose monetary policy. We are seeing some support on the credit cycle with growth in money supply after quantitative easing. In their previous programs, such as LTRO and negative interest rates, that remain there. So now the fundamentals in the economics are pointing in one direction, but on the other side, the things that are pointing in the wrong direction or the opposite direction would be the fiscal policy, their fiscal side. Now this year, Spain, Portugal, Estonia, and Finland are having elections, and we already see one in Greece. So we believe that there's a good chance that the policy consensus will be debated, and we might see we might see oppositions with anti-austerity policies in the government. So that will disrupt the fiscal side, and so that is the biggest headwinds at the moment. Now, we all know that ECB has done a lot, although they haven't been able to achieve their inflation target, but they have been very generous in terms of their loose monetary policy. And we have already started to see some of the results through the data stuff. But the problem is they do not have any hold on the structural side of the region, and for that only politicians can handle that. So we believe that the Eurozone's institutional framework is incomplete. Most of the member states, including their three biggest member states, France, Spain, Italy. On the right-hand side, you can see their fiscal budget deficit, which, although improving, is still on the negative territory. It's because their inefficient labor market is paying out things around 22%, and their extensive bureaucracy. The government themselves are the biggest problem. We would like to see some more reforms in terms of reduction in taxation of labor, combined with the subsequent increase in value-added tax that could boost some consumption and introduce some new expectations for inflation. For 2015, we also see some headwinds turn to tailwinds, including the lagged effect of weakening euro, easing fiscal austerity, and more certainty on the banking sector. That's will be provided by ECB. We got a few unit trusts in ETF here to the proxy Eurozone market. And to end, I would just like to discuss in 1 minute time that what happens if Greece has to exit. Although as of now we still believe that the probability of Greek exit is still very low, but what if these things happen? So first, this thing will be hugely negative to the Greeks themselves. they will be secluded from further funding from the ECB, EU, or IMF, which so-called Troika, and they might have to. We expect that they will have some strong financial stress in the form of bank run, and probably they would have to rerun the election. If such chaos prevails. For Europe, even without a complete breakdown of euro, Greek exit will leave the ECB holding billions of dollars of Greek debt, and around 60 to 70% of them are attributed to the Eurozone area only, and the biggest lender are Germany and France, so they will affect these countries, these member states as well. And European Union as a whole, which accounts for around like 1/5 of the global trade, if anything happens to this region, we'll definitely see some effect on the global economy as well. Maybe a slowdown in the global markets, especially because we all know that the global economy as a whole still remains fragile in the initial stage of recovery. So with that, I will pass this presentation to my colleague. Guide you on the Civmec update.
Hi, Kenneth here, just to give you an update on opportunity we think about Civmec. So basically, just a quick summary on Civmec, right? So Civmec was basically one of the premier civil engineering companies in Australia, okay, which we initiated a few months ago. So basically, stock prices has dropped a lot in the past 2 weeks, okay, and we believe it has dropped way below what the fundamentals are worth. Just to give you some context, Civmec sold off by 30% over last week, okay, and management has actually replied publicly, responding that they are aware of a large shareholder, which is not a substantial shareholder, have been selling his stake for personal reasons. Okay, and this broke through a lot of technical levels, and it was of 40 cents since last week. It dropped from 60 cents plus. Now the thing is this, right? There's no change in the fundamentals, and we just like to reiterate that Civmec is a pretty good fundamental company with strong ROEs. ROEs have been trading at ROEs have been at 19%, and they actually have little net debt. Okay, and right now they're actually in the midst. They're not loss making either. Okay, so based on strong ROEs, having little net debt, and earnings are still profit making, okay, we think that right now at the price it is, it's really good value. It's a good value right now. Now, just to be clear, we do agree that net earnings this year will take a hit compared to last year, but that's because they are trying to expand into new markets right now, right? So their margins are suffering a little bit. And there's a shifting project focus into infrastructure. So even though oil and gas and mining has slowed down somewhat in terms of sentiment, but at the same time, right, Australia is having an infrastructure stimulus right now worth about $165 billion for the next 10 years. And Civmec actually is in prime position to capitalize on that. Recently, they've already got 2 infrastructure orders in to the order book that shows that they have been capitalizing on it. So we think that at this price, that already implies a forward PE, FY15 PE of 8.2. Sorry, the PE right now is 7 times, okay, and we peg it to conservative 8.2 times PE, which we think is cheap considering that the year after they are probably going to grow because of their investments they've been making to bring to new markets. So we had a reduce before this, but we think now that the price has dropped so much, we upgrade it to a buy. So that's for Civmec. Okay, also just a quick update since I'm here. We actually released 2 technical reports on gold. Well, actually, to be clear, one is a technical report which we call Technical Ideas. Okay, and the key idea is that we describe a little bit as to what the nature of the price movements will be like going forward, likely, and that we're probably having a short-term cycle up right now. Okay, but the next one is of interest, so I advise you to go check it out. We basically, because of the, I guess you can say, the uncertainty surrounding gold, we basically decided to do, for our clients, we optimize an end-day breakout quant strategy, trend following strategy on the GLD, okay, which is the gold ETF. So this basically, here we optimize the end-day breakout strategy. We give you the parameters, we optimize it, and please do check it out. So basically, it allows you to profit from price cycles, whether the price goes up or it goes down. It's actually a simple, straightforward strategy that we optimize for you. Please look through it. Please give me your comments, because if you like what you read, then I can actually start doing optimizations, right, on other assets as well, not just the GLD. Okay, so I just basically wanted to update you on these two things. Okay, so all right, so now I'm gonna pass you to Yong Kai, who will give us an initiation on Sina Corp.
Hi, this is Yong Kai here. Hi, this is Yong Kai. Sorry. Okay, there's a US equities analyst. So I'll just quickly go through our initiation on Sina Corp last week with a non-retail call. Okay, so just a very brief background. Sina, okay, I'll just pronounce the Chinese name. Sina is better known for the web portal, which is the 10th most visited website in China. Okay, the idea that I want to bring you all to focus today is that Sina is trading below the sum of the parts valuation. So the market cap is 1.91 B, whereas the sum of the parts is 2.45 B, consisting entirely of just liquid assets and net cash. Okay, in this breakdown that we have given, it hasn't included about $200+ million of receivables and prepaid expenses, as well as another $228 million of long-term investments that is held at cost but not reflected over here. Okay, the biggest part of this sum of the parts is Weibo, which is about 1.6 B. So this is about 2/3 of the sum of the parts. So we have actually included the 3-year user growth as well as the monetizations in the last 3 years. You can see that the Weibo users growth has actually been compounding very nicely. They have more than doubled in the last 3 years, and year over year in 2014 actually is increased more than 30%. Whereas for the monetization, you can see that the revenue has grown from near zero per user to about 51 cents. Okay, so this is done purely by just picking all the low-hanging fruits. But you can see also that Weibo is lagging behind Twitter in terms of user monetization, and this could be partly attributable to their user base mostly being in Chinese in China rather than the more valuable US. Weibo, what it does is actually is China's Twitter. So if you're familiar with social media, you know what Twitter does. The nearest competitor will be more from the Tencent-backed WeChat, which is more akin to WhatsApp. Okay, so why we think that Weibo there is at least some basis for this value to hold, because currently it's trading at $14 per user versus Twitter's $97 per user. Even if we adjust for the lower monetization as well as the lesser users, Weibo by right should be trading at $32, not $14 today. So what might happen from here? Sina might trade up to some of the parts, which is 28% upside. The share buybacks below some of the parts will be accretive. Valuations of equity stakes such as Alibaba, Youku, or Tiange, eHouse might drop. So this will converge the valuations. Also, you might spend some of the net cash on M&A. So this will make it harder to value going forwards. So again, we want you to think of this as a sum of the parts story, which has not factored in any of the 200+ mil working capital, as well as another 200+ mil long-term investments. So just to highlight some of the long-term investments, the reason why we didn't put it is because it's not very transparent right now. It actually has about majority stake in Xinglang Aicai, which is the online lottery operator with 7.4% market share. So this operator actually made roughly 200+ mil sales in third quarter 2014, and profitable enough to pay out $7.8 million dividend to Xinglang in the fourth quarter last year. Okay, but the financials are not publicly available. Alright, moving on, I'll hand you to my next colleague.
Hello, morning. This is Caroline here. My colleague De Hong has actually initiated CapitaRetail China Trust last week. He's not around today, so I will be making the presentation on his behalf. The CapitaRetail China Trust CLCT has a portfolio of about, I repeat again. The CLCT has a portfolio of about 10 retail malls in China, primarily in Beijing, with about 78% of the portfolio by valuation and 75% by NLA in the core capital Beijing. So other regions include Shanghai, Wuhu, Anhui, and Inner Mongolia. Our main investment thesis for CLCT is the long-term secular growth of the Chinese consumer story as China seeks to push towards an economy driven by the domestic consumption. Beijing is a huge beneficiary from this rapid urbanization and the pro-consumption government measure, which we will touch on in the next slide. Below here is the list of the CLCT mall across China. You can see that there is pretty healthy overall occupancy rates across all the malls except two of the malls here, the Wuhan Minzhong Leyuan and the capital Wuhu in Anhui. The Minzhong Leyuan was affected by the road closure to build a new subway line, which will expected to be operational by end of 2016, after which the management is confident of the vibrancy of the new subway line can bring to the surrounding areas. As for Wuhu was affected by the government decision to convert the use of the surrounding land areas from residential to commercial. So what the management is actively doing is repositioning of the tenant mix, and this is expected to take place till end of this year. For both of the case, it were due to more or less uncontrollable factors. But however, we are not so worried about the overall performance for CLCT because the Minzhong Leyuan and Wuhu is only taking about less than 10% of the overall portfolio revenue. We next touch on the next big picture story, the Chinese consumer growth story. China pushed towards an economy driven by domestic consumption, and pro-consumption government measures are expected to benefit the retail sector. The government measures are in these four areas. Number one, the rapid urbanization, and number two, the increasing disposable income and consumption expenditure per capita. Number three, the sustained job growth as China moves towards better quality growth. And lastly, the recent easing monetary policy. These four factors will likely lead to the growth of the Chinese consumer, and it will increase the discretionary spending driven by the rising disposable income. Beijing is likely to be the huge beneficiary of the rising urbanization. As can be seen from the chart, Beijing has the highest population growth rate among China's top 4 cities with the largest urban population, including Shanghai. Disposable income growth and consumption expenditure per capita growth has also outpaced other rest of the urban China. In recent months, we have seen the People's Bank of China re-embark on a range of monetary easing policy to boost the economy. These include lowering interest rate and relaxing loan policy. The accommodative approach is expected to stimulate the economy with cheaper credit as well as boost domestic sentiment and consumption. For instance, over here, we have seen a boost to the Chinese stock market, which has risen 40% from start of November 2004, the month during which the People's Bank of China first announced cuts in the benchmark rates. This could likely create a wealth effect and spur the consumer spending. A lot of focus is also on China GDP growth of 7.4% last year, which was the weakest in 24 years. However, because China growth has gradually shifted from manufacturing-led to more service-led, which tends to be more labor-intensive. As a result, 30.2 million urban jobs were created last year, more than the 12 million created in 2007 when the GDP actually grew at 14.2 then. Although the year-on-year retail sales growth has seen a decelerating trend from 2010, which is at 18.3% year-on-year, to last year 2014 at 10.3% year-on-year, we think that this deceleration could bottom and will start to gravitate towards the 12.7% compounded annual growth rate of urban consumption expenditure per capita as a result of the previous supporting factors we have mentioned and the accommodative monetary policies. We next touch on the company analysis. Staying nimble to spot the latest fashion, F&B, and the consumption trend has been the top priority for CLCT management. Pulling in the right tenants can boost footfall in the malls and increase the tenant sales, thereby increasing the ability of the tenants to pay higher rent. Over here, you can see we can see how healthy shopper traffic growth from this chart, with the exception of Wuhu, which we have touched on earlier why it was affected. The performance was not as good. As a result, we can see over here the tenant sales more than often, if not outperform the general retail sales index. The average year-on-year tenant sales growth of 17.9% has outperformed the average general retail sales growth of 14.6%. So we can see that for CLCT, management has actually been able to push for better performance for their malls in China. Next is a table showing the peer comparison between CLCT and the rest of the peers. We do not have a close match listed locally, but the closest local listed peer will be maybe Fortune REITs. However, Fortune REITs owns shopping mall in Hong Kong, which involve a different dynamics, and USU is actually listed in Hong Kong then. The key risks that we would like to highlight for CLCT is number one, the growth in the online shopping, proliferation of e-commerce platforms such as the WeChat, and the frequent marketing gimmicks such as Alibaba hugely popular 11 November Single Days, which is also known as the Guanggunjie, could cannibalize sales from the brick and mortar stores. And another risk we have also identified is the increased household saving amid the falling consumer confidence. Uncertainties over the economy and housing could lead to falling consumer sentiments and the tightening of the purse strings. So overall, we have come to the overall presentation of CLCT. We have an accumulate rating with a target price of 1.70. Thanks, and we are open to the Q&A. Thank you.
Hi, this is Yongkai here. So we have a question from the audience on Singlang that the stock has been on a downward trend since 2011. What could be the possible reasons? Is there something fundamentally weak with its business or business model? Okay, so Singlang itself is a portal website. So by virtue of being a portal website, it's hard to scale when it comes to mobile. As you are mostly aware, there's huge user migration from PCs to mobile. So Singlang website itself hasn't been performing well. The Weibo is actually doing very well. The Weibo monetization has they have been slow to take a playbook from Twitter, so this is something that we observe. But Singlang recently also has been spinning off quite a few of the previously long-term investment companies, such as the Alibaba as well as the Tiange. So going forward, I think the right way to approach Singlang will be this more of a venture capital company, and you can expect them to be incubating quite a few. Once there will be, we should see IPO in the near future. Thanks.
Hello, okay, Kenneth here. So just to address some questions, okay, on Civmec. So one question is Monadelphous. Basically, it's a comparison between Civmec PE and Monadelphous PE. So here's the justification of the PEs and differences between Civmec and Monadelphous. Okay, so the thing is now one of the questioners have rightly pointed out that Monadelphous has a slightly higher ROE, but net margins is lower, so which is better. I mean, the thing is this, okay, first of all, Civmec and Monadelphous, right, they only overlap in certain things, okay? For Civmec's case, you have to refer back to my original presentation, they don't have a direct competitor. To be frank, right, the closest, I guess, comparison you should make is Oz Group. And Oz Group and Civmec performs a lot better than Oz Group. So but I can't compare it with Oz Group because of the structural changes Oz Group is having. So the next best I could use was Monadelphous, which to me was like, it's just the closest, but it's not the same, okay? Now, here's the difference between Civmec and Monadelphous. The thing is, Civmec actually has a market cap, right, which is about one-third that of Monadelphous. What does that mean? See, it means that Civmec is not as easily trapped, I would say, in terms of earnings growth based on what is happening in Australia alone. And that's the very key thing. The reason why we gave Civmec a slight premium over Monadelphous in the first place was that Civmec had the potential of growing faster. Because Civmec basically, right, only has operations on the west coast of Australia. Basically, most of it is there, and they can expand to the eastern side and they can expand to Asia. And because their market cap was about 170 million, any incremental changes in earnings, right, will impact Civmec better. Now the thing is, Civmec's system in itself, okay, they do fabrication, etc., etc. The things that they're already getting a very good reputation, and in terms of efficiency and their performance. See, so once you have a robust system, right, the probability that they can grow based on market penetration, I mean, I think it is there. So even though Monadelphous has a slightly higher ROE, right? Don't forget it's slightly. I mean, Monadelphous ROE is like what, 33%. Civmec is like 28.6%. I mean, the difference is very small. To me, they're about the same. So based on that, right, you look at Civmec, which is better margins, showing that they're more efficient, and they've got more growth opportunities. So that's why I gave them a slight premium over Monadelphous, okay? But to be even more conservative, right, after giving them 10 times PE versus Monadelphous, right, I rated it downwards just based on the sentiment between the Straits Times Index and the ASX 200. Because the ASX 200 is trading at a much higher valuation. Forward PE is 17 times, whereas in the STI it's like 14 times. So basically, I took 10 times PE of Monodelphus and I rated it down versus Monodelphus and I rated it down to 8.2 times PE, which I think is quite reasonable already. Don't forget, if you want to compare peer to peer, right, you should be valuing it to basically to Oz Group, which is trading at a much higher PE. Yeah, so that's the reason of the justifications, lah. Hold on while we tend to your next few questions. Hi, I got two questions regarding 800 Super. Okay, regret to inform you that the covering analyst, which is Richard, he is at present serving the country and will not be back until 2 weeks later. So please reserve your questions for that. Yes, sorry about that. Okay, while we're waiting, we're going to wait a little bit longer just to see if there are any more questions. But while we are waiting, right, I'm going to just take this 2-minute period of time to talk about this, right, the two reports today. Likely for the quant idea report, right, likely I will probably explain more about it in next week's webinar. So if you want to basically have a summary of how I did it, if the report is not clear to you, or if you have questions, please reserve it for next week, and I'll explain to you what I did, how to use the strategy, what can we glean from the strategy, and issues with the strategy, etc., etc. Okay, but I think that it is a good first attempt, and hopefully it does well with you guys. So please give me comments for next week. Just to highlight, right, for the trading strategy, right, basically the backtested results were that it can attain an annual gain of about 10% without leverage, right, regardless of market direction. And if you placed in optimum leverage, which we also backtested, right, you can gain about 20%. So based on this, right, the study is worth going into. Okay, okay, I think we're going to close today's Monday webinar. So thank you for tuning in, and we'll see you next week.